What is this world coming to? First, JC and Dio take a 2-week hiatus. Never before has that happened. Second, the government is shut down. Third, FICO is flipping the script. And then fourth, what's up with all of the AUS denials? Tune in. JC and I are going to rapid fire all 4 of those topics. Check this out. Ladies and gentlemen, boys and girls, children 18 plus. You are tuned in to the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC.
John Coleman.
Yo, what's poppin'?
Hey, we're back and better than ever.
I tried to get away.
You tried so hard to get away, literally.
Man, I tried so hard.
We are 575 episodes into this. 577 episodes. Not that I'm counting, but obviously he is. and we have never missed a beat. Even when I had COVID, I think we dropped like a repurposed
one. But because I don't think people cared. Shout out in the comments if you actually cared and or noticed that we even took 2 weeks off.
Well, I know people noticed because I had people reach out to me concerned that I was back in the hospital with heart issues.
Shout out.
I had someone concerned that like we just stopped recording altogether. And no, like we have been up to something. We're cooking something good.
Cooking that heavy crack.
Yes.
In that kitchen.
Yes. But it's time for us to get intentional.
Yeah.
It's time for us to elevate. I think the people deserve better. You told me that. John came into my office and says, hey, people deserve better. I said, John, you don't care about people.
I don't, but I was sober too.
Yeah. But
Stone cold sober, being like, I think we need to up our game.
Yes. And in order to do so, we decided to go dark. We went dark for 2 weeks. Didn't really talk about it. I finally posted about it on LinkedIn today.
Okay.
And then this is the first true The Loan Officer Podcast episode to drop since the hiatus.
Yeah.
And here's what y'all should notice. And by the way, we did an entire episode that we dropped on Monday to prep what this looks like. But moving forward, TLOP truly is going to be leaning into the shit they didn't teach us in school.
Yep.
At the same time, we are out to shape the future of the mortgage industry by being the best coaching platform, the most affordable coaching platform, the fastest growing coaching platform in the industry.
Yes.
And that doesn't just happen without a lot of work and a lot of intentionality, which is what we're going to be up to.
Correct.
Anyhow, thank you for everyone who did notice. For those that didn't, I guess you proved John right, so he appreciates you. But for everyone else, we appreciate you noticing. We're back. We're better than ever. And just stay tuned, right? Yeah. Let's take a quick pause so we can hear from today's show sponsor, and then we'll bring it back so we can knock out FICO, government shutdown, and what the hell is going on with my AUS approvals. It is the biggest and arguably the best mortgage conference of 2025, and it is happening in Dallas, Texas. We are talking Sales Mastery, October 14th through October 17th. This is Todd Duncan getting together with Don and Gino from Momentum Builder and combining 2 awesome events into one. Sales Mastery was the very first mortgage event that I ever attended, and it's still one of my favorites to go back to. And I can't wait to be in Dallas, Texas, October 14th through 17th. If you want to join me and thousands of other mortgage professionals, all you have to do is go to salesmasteryevent.com and register. By the way, use the code TLOP for your discount. That's TLOP for a discount. Who else is going to be at this event, you're probably wondering? We have best-selling authors, we have performance coaches, and some of the best originators in the industry.
Okay, I think I can handle these.
Kenny, where do you want to start?
Let's go what's going on with my AUS approvals. AUS stands for Automated Underwriting System.
Ding, ding, ding. Look at this.
I'm going to try to be more intelligent.
Later.
I'm just playing. I played stupid.
No, we know you're not dumb.
I know, but it's easier to play dumb and have people think you're dumb than actually like talk smart and be smart.
Yeah, and it's okay for you not to want people to think that you are a
college educated man.
No, mortgage originator.
Oh, my bad.
Yeah, like you're
I went to college. That's why I'm not an MLO.
Okay, very good. Well, I went to college as well, and I am an MLO. So, no. So AUS approval. It's just FYI. If you haven't noticed this, and I'm hearing this from our coaching students, people on the Mortgage Mafia Facebook group, like, By the way, if you're not on the Facebook group Mortgage Mafia,
the hell are you doing?
What are you doing? You're missing out. It is a private group. You have to be a licensed, employed MLO to be accepted in. But do you know who accepts people in? Me. I do. So check it out. But we've been talking a lot on the Mortgage Mafia private Facebook group, and people are like, WTF, like loans that I used to easily get an approve eligible on, I'm now getting a refer. Loans that used to get an accept, I'm not doing it. And some people are like, hey, try this. Literally put an extra $500 down. Put an extra $2,000 down. Play around with more reserves, and sometimes those tricks will work.
Why? What happened? Did someone change the algorithm on the back end to where something happened?
Yes.
Because of AI. It's all AI's fault.
It's not all AI's fault.
Oh.
No. If we study how the sausage is made in the industry, and we realize, well, what's going on right now? Well, we have this guy, Bill Pulte Jr., right? He's the director of the FHFA. So he's a Trump appointed or a president appointed. Doesn't matter if it was Trump or Obama or Clinton or Kennedy or Nixon, but he's a presidential appointed person. And this administration and many people in the industry support. So this is not a political statement, but they're really wanting to get Fannie and Freddie out of conservatorship. They want to release them, recapitalize them, even raise some money by taking them back public, right? Meaning you can buy more stock, like not all the stock, like 15% of the stock. And in order to do so, you need to get support from the industry. So let's just think about this. If you're Bill Pulte and you are the puppet master of Fannie and Freddie, because that's the government entity that has Fannie and Freddie in conservatorship is the FHFA. How could I incentivize originators to use me less and start using, I don't know, non-QM lenders more, or what we call private label securities more, PLSs? How do I get Wells Fargo, Bank of America, and Chase to want to start securitizing their own private label securities and not relying solely on Fannie and Freddie as their exit strategy? Well, let's make it harder for people to get loans approved, so therefore they can't sell us as many loans as they used to. We still have that many home buyers. We still have that many people who are interested in a refinance, but we behind the scenes are going to tighten things to make it more painful for originators and lenders to actually deliver loans to us, which will force them to deliver loans to other people. And if other people don't exist, but there's capitalists and entrepreneurs out there, and they're like, wait a minute, these are really good loans. These are 800 credit scores, blah, blah, blah. I know. Let me create my own security. Let me come purchase these loans, and I'll hold them on my books, right? So that's the theory, that's the thought, and that's what's going on. So just FYI, y'all originators and mortgage brokers out there, something that you used to eyeball, like it would pass the sniff test. Like, oh, look at that file. The DTI is 36, the LTV is 95, blah, blah, blah. I don't even need to run this through AUS. I know I'm going to get an approval. Like, don't hold your breath.
How long do you think this experiment's going to last for? Like, hey, I know it's rough now, but probably by July of next year, things will go back to normal? Or?
Well, I couldn't guess that. Like, I couldn't guess that because this current environment is probably the most keep you on your toes. We're going to keep you guessing. Look over here while I do this. While I do that, I'm really doing something else. It's a
right. But I fear traditionally though, aren't they trying to make home ownership like more accessible for everybody? And it seems like this is a game just for like more capitalistic monopoly rather than like helping the homeowner.
Yeah, that's a great viewpoint. Yes, we as a society, and I think it's not a red, blue, or purple thing. Like I'm sure both sides of the aisle are totally fine saying, yes, I stand behind home ownership. I want to promote home ownership. However, the question is how much of that home ownership should be backed by the U.S. government versus how much of that should be backed by the private sector.
Right.
So if you're the U.S. government and these are government entities and you want less market share, then you make it more difficult for people to deliver loans to you.
So who's gonna catch the brunt of this? Is it gonna be loan originators? Now they can't just not blindly look at AUS, and how's it gonna trickle down effect for homeowners?
Yeah, so you're gonna have loan originators that are accustomed to running certain scenarios through and just assuming it's gonna go, and all of a sudden they're gonna get sucker punched and it's not gonna be eligible. At which point they're gonna have to get creative, maybe go back to the borrower, have them put more money down, have the borrower disclose more assets, add a co-signer, like all those things that we have to do to make this file stronger. If that doesn't work, then they're going to have to flip it to a different type of product. So maybe you flip it from conventional to FHA and now it goes. Or you start looking at one of your non-QM lenders and you see, well, would this person qualify for a no ratio loan, or would a bank statement loan work better here because I'd have more income? If it's a second home, should I just go DSCR on a second home instead of trying to go conventional? Like, there will be things that they have to do. Ultimately, what do they want? They want the Chases of the world to be like, that's a good loan. I'll do that loan. But instead of that loan ever being delivered to Fannie Mae and Freddie Mac, it gets delivered to Chase.
But how long, real talk, if they just turned the widgets on the background to make it a little bit more tighter, how long until we actually see the Chases be like, that's a good loan, 5 months, 6 months? It's not going to be.
That sounds good to me.
About 5, 6
Yeah, that sounds good to me. I mean, at the end of the day, like, these banks and these investment houses, like, they're not immune to it. They remember how the world worked prior to the financial meltdown, right? So prior to 2008, like, and don't quote me on these exact statistics, but it was something like 36% of the loans went to Fannie, Freddie, or to HUD, right? Fannie, Freddie, Ginnie. Right now, it's been more like, depending on the year, 90% or 75%. Right. So right now, maybe 75% of the loans being originated are some kind of a Fannie, Freddie, or Ginnie security. So that's double what it was just 15 years ago. So there's hope that the private market will come back. Private market hasn't come back on its own. Right. They're like, nope, don't want to do it. Right. Like, I'm still remembering what it was like in 08, 09. But is there a way to entice them with a good enough rate of return? So that's what's going on for the originators.
All right, and to put a bow on it, what's your DOism on this? Like, oh, yeah, you can't do anything about it. Just go out there and get another lead.
It is what it is. Like, our job's to find a way to yes. That is our job, right? If I was a warrior and all I had was a freaking broomstick, I guess I got to be the best warrior with a broomstick. I'd prefer to have like a flying star and a sword and a shield.
Flying star, huh?
Is that what they called?
Oh, wow. Where'd you get that? What you been watching, huh? Flying Star.
Yeah, the stars that you throw. What do you call them?
Yeah, you're right. But okay. For you to go with that, like,
I don't know,
melee weapon first, it just shows I don't know where your head's at.
I like to throw things. That's the one God.
Yeah, you love throwing shit against the wall to see what sticks.
Well, I do that too.
Yep.
No, but my sports career was about me being able to throw things really far and really hard. My sports career stopped in high school because I couldn't throw them very accurately.
Hey, playoff baseball's on, and like that's way better than like the regular season.
Playoff baseball is legit. Playoff baseball.
I was watching that shit. The pitchers, I'm like, oh wow, they're trying. Everybody tries.
Yes, playoff baseball. The past 10 years, especially.
Let's just skip everything and just go straight into playoff baseball. Can we do that?
Like, I don't even watch NBA till the finals, and I don't start watching until Game 4.
Stop.
Game 4 of the finals.
People don't even watch the finals. On to our next subject. Right. We talk about FICO scores.
FICO scores. This is like just out in the news right now. So we all know, if you've been in the industry, we've seen our credit report bills just skyrocket, like triple overnight. And FICO is the one getting the absolute brunt of it. Oh, FICO's increasing their fee. FICO's increasing their fee. Here's the deal, y'all. What you have to understand, I'm not even defending FICO, by the way. I'm not. But FICO is the algorithm, okay? Then you have Experian, TransUnion, and Equifax. They are the data collectors. And then you have your various like credit reporting companies. Like I can't pull credit through FICO. I can't pull credit through Equifax, TransUnion, or Experian. Like, I pull credit through either Kroll or through CIC, or like there's credit vendors I pull credit through. So by the time that I get a credit report bill, that bill is actually coming from the credit vendor, which is who's doing basically the administrative work. The credit vendor has to then pay Equifax, TransUnion, and Experian, and then Equifax, TransUnion, and Experian then pay their money to FICO. FICO is essentially the algorithm. They are the drug, right? Like, they created the drug, and then these three companies, TransUnion, Experian, and Equifax, they are the, let's call it the doctor, and then the credit reporting, the agencies that we pull credit from, right? They are the pharmacy. Okay. So we all get the same drug, which is FICO. And then it depends on what what doctor you're going to, TransUnion, Equifax, and Experian, which in the mortgage industry, it's all three right now. That's why we have tri-merged reports. But then there's multiple pharmacies that you can actually go to pull your tri-merged report. So FICO announces, F it. I'm going to bypass, in this analogy, the doctors, and I'm going to actually take my algorithm and just shoot it right to the pharmacy directly. And the goal is, how do I drive the cost of credit reports down? How do I get the scarlet letter off of my chest? And how do I get the bad PR off my name and just show that I'm trying to find a way? But I've talked to some buddies of mine in the industry. Like I was talking to Rob Chrisman about this when I had a chance to hop on the big picture with he and Rich Strabinsky, which shout out to Rob and Rich. I freaking love both of them and their show. I was talking to our guy, Craig Davis, about this, and we're all shrugging our shoulders. We're like, I don't see how this is possible because we as lenders still have to do things like credit rescores. We have to do credit updates. We have to like add certain trade lines. Like there's certain administrative paperwork that has to be done. And I don't know how the credit vendor is going to be able to do that if we're cutting out Equifax, TransUnion, and Experian, because they're the ones that actually collect the data on people's spending habits, on people's payment history. And FICO is just the algorithm that we use. So it's in the news. I've been asked 3 times about this in the past 24 hours. This is one of those, John, put your head down, your blinders on, and go get another lead.
Bro, honestly, I tried to listen to what you're saying, but I glossed out about halfway.
Yeah, just go get another lead. Make another sales call.
What does that mean? Does that mean like, hey, someone who used to have like a 412 credit score now has like a 510?
No, not one bit. This is not consumer at all. The only place the consumer wins or loses here is if we're able to drive down the cost of credit reports. Okay, that's what this is trying to do. FICO is trying to cut out a layer of fat, let's call it, and allow the mortgage industry to operate with lower credit bills, at which point the consumer will benefit because they'll have lower cost. But what are we talking about? Maybe $100 less on a transaction where their closing costs are $6 to $12,000.
Gotcha.
Right. So it's pennies when we're talking about dollars. However, it's such a hot topic in the mortgage space where, FICO is just getting bashed, and the CEO of FICO is making $36 million is being turned into like this evil person. FICO basically just gave the credit industry double middle fingers.
Watch this.
And now a lot of that has to stem from these two things, and we'll move on to the last topic. That same guy, Bill Pulte, has been very vocal and loud from the FHFA, and Bill's like, you know what? If FICO keeps on raising their prices and mortgage lenders and banks are screaming that prices are going up and it's becoming more expensive for consumers, I'm going to allow a different scoring model to be used. We don't have to use the FICO scoring model. We now can use the Vantage scoring model. We talked about this on an episode like 6 months ago.
Yeah, I remember that.
Well, you know who owns Vantage?
It's probably somebody else who owns FICO.
Nope. Equifax, TransUnion, and Experian.
This sounds like a pound.
So all of a sudden, Equifax, TransUnion, and Experian are trying to cut out FICO. So FICO's like, cool, right? You're gonna try to cut me out?
Watch this. I'm gonna start my own.
Watch this. I'm gonna cut you out, and I'm gonna leapfrog over you.
So petty.
At the end of the day, we as lenders, I guess just tell me where to pull my credit and which score to use.
Just tell me what button to click. I don't care what the logo is, what color it is. Just tell me what field I need to enter.
Yes, and trust me, I ran P&Ls for 15 years.
Jeez.
7 branches. I've seen my credit report bill $20,000 for the month. Like $20,000 is my credit report bill when 2 years prior it was $8,000. So I know what it can do, but when it comes to the consumer, we're talking pennies, not dollars. So LOs that are curious about what this is going on, like you should know enough to talk about it because we all should be subject matter experts in our craft, right? We should be the source of information for the communities we serve. Know enough, but you don't have to be dangerous with your knowledge. And at the same time, knowing this won't help you get another lead. Knowing this won't actually send that newsletter for you. Knowing this won't actually attend that networking function for you. So I think you just move on, but be aware that this is going on and tell the communities you serve, hey, good news. Good news. In the future, 6, 9, 12 months from now, with a bunch of unknowns, in the future, there's a great chance that we're going to have some choices when it comes to credit, and the cost of credit may come down. What does that mean to you, ma'am or sir? I may or may not be able to approve more loans, and I more than likely may save you $50 to $150 on your transaction, which, by the way, your closing costs are going to be $6 to $12,000, but I can maybe save you an extra $100 only because the credit industry went to war, they started fighting, and now there's actual competition that's driving costs down. So that's that. Third topic that we were going to talk about besides, TLOP 3.0, I think was government shutdown, right?
No, is it?
Yeah. And
the roads still work. The lights still work.
They do. And here's the deal with government shutdown in general. Like, trust me, I know it sucks for the furloughed. I know it sucks for people who are working and their paychecks is being delayed. And obviously, if you get laid off, that's freaking awful, right? All because grown-ass men and women couldn't negotiate and they couldn't compromise. I'm married 23 years.
That takes no compromise.
That is all compromise and all negotiation.
Yes, we lose every time as the man.
Like, I'm trying to book a vacation for me and 4 other people. That takes negotiation and compromise. Like, we all don't want to stay at the same hotel, go to the same meal, or pay the same thing for the excursions, but we got to figure that shit out as a group. Okay, when this podcast episode drops, I don't know, maybe the government's back together, right? But here's what I do know. 2018, we were dealing with this. 2025, we're dealing with this. And every year from 2018 to 2025, there was a scare. Oh my God, what's going to happen? The good news for the masses, and that's why I want to throw it out there first. Like, hey, y'all, like I do feel for the people, and it totally sucks. And there are 1,400 transactions that probably will not close on time during the shutdown just in the state of Florida. And I feel for those sellers. I feel for those buyers. I feel for those realtors and the lenders. Like, I do feel for y'all. But at the end of the day, we're lucky in the mortgage and real estate world. The government shutdown impacts us minimally. Now, someone could argue, but D.O., it was unnecessary. If those clowns in D.C. could have gotten their shit together, we would have had no transactions missing their closing date. But when this happens, here's typically what I look for. And this is for consumers, this is for realtors, this is for loan officers. When the government's shutting down, the big oh shit moments, if you have a USDA loan, probably not closing. Now, we don't do as many USDA loans in 2025 as we did in like 2015 or 2012, but that's a great loan product and you're just not going to operate. You can't get those loans approved without getting them first guaranteed, and you can't get something guaranteed at the office is shut down. Second thing, and I'm in Florida, you're in Florida. We got Texas, we got California, places where you have lots of floods. Like, you can't get flood zone. You can't get flood insurance for homes in flood zones. Now, there is such a thing as private flood insurance. It's not always readily available, and it's freaking expensive. And expensive private flood insurance may make my debt income ratios too high to even qualify for the loan anymore. But that's something that right now our Mortgage Bankers Association is trying to advocate with the government, saying, hey, y'all can be in your little argument and y'all are like not getting along, but you gotta fund the national, I think it's the NF. I should know this. Anyhow, it's the national agency that basically supplies homeowners or home buyers that are buying homes in a flood zone with the insurance that they need in order to procure the loan that they're using to buy their home.
What happens if I'm a loan officer and or a client, and like I worked for the government and I was like affected by this shutdown, and let's say I was like 2 weeks, like I was about to close on my house.
Yeah, we're gonna put pause. We're gonna put a little pause.
Real
button.
talk, they'd be like, yo, everything was fine, and so I'm like, all right, so is this like, all right,
well,
hit
like,
pause.
How do I know if you can make your mortgage payment? Like, how do I know that you're gonna have a job?
So then when that hits pause, it's like, all right, wait and see until you get your job back, and then like we'll pick it up from here. Do I have to like resubmit everything again?
Usually no. And look, Fannie and Freddie, I don't want to make it like a whole big deal into this, especially because by the time this airs, it may be like moot point, right? But there's certain things that Fannie and Freddie are already posting where they're like, hey, typically I need a pay stub that's within 30 days of your closing date. However, if for whatever reason you can't obtain a pay stub within 30 days, we're fine taking one within 60 days. Like there's certain things that they are willing to work with. Or like, how about this one? If I'm doing a loan for somebody and I need a tax transcript from the IRS, but the IRS is closed down.
Right, yeah.
Now, right now, the IRS isn't closed down. What's unique about this government shutdown is the IRS had additional funding left over from a prior funding round. So the IRS actually stayed open for an extended period of time past the other government
figure the
agencies.
IRS is sitting on mad money. Who would have thunk? Yeah.
No, the IRS, they take that money and go use it elsewhere. But anyhow, there's ways. I was explaining this to one of our coaching clients. Whereas, like if I'm an underwriter and I have a self-employed borrower, and the self-employed borrower gave me their tax returns, and I've underwritten the file, I've approved it. However, I still need to audit to make sure that that's the actual real return and not a fake one. So the way I audit it is I submit for IRS tax transcripts. The transcript would then, if it mirrors the actual return, then I know it's legit. Well, if I can't get the tax transcript, could I get into that person's bank statement and see either they received the refund, that they received the refund, or they made the payment for what was due? And as long as that refund or the payment that they made matches the same number that was on the return, do I feel comfortable enough signing off on that loan? I can get that tax transcript later down the road after the fact once the government's back open. So these are things that are impacted. Then you always get like less than 1% of all VA loans require the VA to actually sign off on the loan, right? Only less than 1%. However,
yeah,
if you have one of those loans that requires VA, direct endorsement guarantee, yeah, you're SOL if the VA shut down due to this. Another one would be like with FHA. If you're doing like a manual underwrites require certain things go through HUD. If the HUD office is closed, it looks like you're not going to get that approval. If you're trying to get like a FHA condo approved and it requires it to go to HUD. So there's definitely people who are impacted. But for the most part, and I talked about this on Instagram, I think yesterday I did a green screen. If you don't follow us on Instagram, it's at the Loan Officer Podcast. You should. There's 7,000 people who are already ahead of you that are getting some great knowledge that you're missing out on. But my commentary was essentially this. Yes, it sucks. However, it's not as bad as the national media would make it sound. It is something we need to be aware of. And yes, if you're a loan officer, you need to be inside of your pipeline auditing it. Who's currently pre-approved and looking, right? Who's currently under contract and looking to close in 2 weeks? Am I going to have any gotcha moments? And if so, let me get ahead of it now, because it's times like these that we're judged the best. This is where you make your money. This is when you make your name. When things go sideways, you have an opportunity to be a hero. Even if you can't close the loan, you can over-communicate, set proper expectations, and calm people down. This isn't your fault, right? It's not the LO's fault. It's not the home buyer's fault. It's not the realtor's fault, not the underwriter's fault. Like, this is just shit going on that we can't control, but it doesn't mean we stick our head in the sand and do nothing about it. So yes, it is impactful. It's not as grandiose as some would like to believe, but it's also something that we don't want to ignore, and we want to be aware of it. And LOs, it's your job to be the source of information. It's your job to be that subject matter expert. So you should be learning about it. You should be posting content about it and answering questions. And you should tell every realtor you know, if you have a file that's going sideways and they're telling you it's due to the government shutdown, call me. Call me, because not every lender is going to be able to operate in the same manner. You may be able to outthink your competition, save a deal, actually find a way to get it closed, without delaying it any longer than what that other lender was looking to delay it. So, that's what's going on. I appreciate everyone tuning in. Anything last words that you need to say before we find a way to wrap this up?
No, because if I added any more, we'd be here for another 25 minutes.
Perfect. I agree. Listen, y'all, if you ever want to know where John and I are going to be next, you got to go to our website, tloponline.com. Under the events tab, you can see where we're going to be in person. You can see what our free masterclasses are. That's also where our coaching students go to see when their next call may be. If you're interested in coaching, you got to check out the 4 different ways that you can allow TLOP to invest in your future success. Click that subscribe button if you're watching this on YouTube. Give us a 5-star review if you're on Apple or Spotify. Remember, sharing is caring. He's John Coleman. I'm Dustin Owen. That's all the time we have for you today, but we do look forward to catching you on the next episode. Peace.